Good afternoon, boys and girls. Welcome to Liberty Call for Thursday, May 19th, 2022. Hope everybody's having a great day out there. It's a pretty decent day here in Colorado, but we got some bad weather coming this way. Watch my mouth. We got some snow and high winds. And so sometime tomorrow into Saturday, we should get anywhere from about 5 to 12 inches of snow. So awesome. I mean, it'll snow in the first week of May, but this late in the month, it is a little bit odd. But when you live at 7,000 feet, these things do happen. So it's not. I don't think much of it'll stick on the ground because it's like out here where I live, it's 70 something degrees in town. It was in the 80s when I just came back from a run into town to get some supplies before being trapped here for a couple of days over the weekend. So anyways, like I said, hope everybody's having a great day. And if it's your first time watching, give me one of these, a big old thumbs up, a like, a share, subscribe, all that good crap. And, if there's anyone you think may get some value out of this, feel free to send it to them. Hey, it's a free world. All right. Ugly day in the markets again. Not nearly as bad as yesterday, but not as ugly if you're short in the market like some people. But, I'd rather, lose a little bit or stay flat than get my butt handed to me like some people are if they're overly heavy in the tech sector, NASDAQ, that sort of thing. So, all right, let's go ahead and take a peek and see how things turned out today. Dow Jones finished down 0.75 at 31,253. S&P 500 down 0.58 at 3,900. NASDAQ was down 0.26 at finished at 11,388. Small caps are up 0.43 today. The VIX actually receded, even with the market being, because let's see, the Dow finished down 236 points, and it was down a lot more than that earlier in the day. But like I said, the VIX was down 5.2%, closing at 29.35. Moving up to Canada, they finished up for the day at up 0.4. Brazil finished up positive 0.71. Mexico was up 1.78. Lots of red across Western Europe. Germany was down 0.9. The UK down 1.82. France down 1.26. Euro stocks down 1.36. The Netherlands was down 2.12. Spain was down 0.83. Who is this? Italy? Yeah, Italy was flat at down 0.09. Switzerland down 2.33. Portugal had an up day. They were up 1.31. Belgium finished down 1.88. Austria up 0.19. Sweden was down 0.51. Denmark down 1.19. The Russian indexes were split. The MOEX was down 0.36, while the RTSI was up 2.73. Poland down 1.4, Hungary up 2.36. So again, it's kind of a back and forth day. Let's move on down to the Asian markets. Japan finished down 1.89, Australia down 1.65, New Zealand down 0.85. The Chinese markets were mixed. Shanghai was up 0.36. The SCSE component was up 0.38. The China A50 down 0.33. The DJ Shanghai was up 0.39. The Hang Seng down 2.54. And the Taiwan weighted down 1.7. So kind of a mixed, if you were to average it all out, I'd say it was kind of a flat day overall for all the exchanges around the world. But hey, those things do happen. So, and actually, let me bring up my chart. We can look and see if we look over here on this side, these are the equities I use in my ETF models, and these top three are large cap, mid cap, and small cap. They were all in the red, while starting with internationals, they were all in the green. So I'll be interested to see, because as you can see right here, this is my large cap position. It's been trending down and continuing to trend down really most of the last couple of months. This is a value fund, so it's not going to react quite the same as a like your S&P 500 or the Dow 30. But looking here at an international, if we can get a few days of positive trend and we break above this downward trend line, It might be interesting to see if the international space actually recovers sooner than here here domestically. So you can see Jake over my shoulder. He's not real impressed. He's falling asleep while I'm talking about finances and stuff. So wake up back there. All right, let's go ahead and dive into today's recap of the market. The S&P 500 struggles for direction as tech continues to stumble. The S&P 500 swung between gains and losses Thursday and remained close to bear market territory as stocks struggled to find their footing following one of the biggest one-day sell-offs since 2020 a day earlier. Technology stocks, which were briefly in the green, came under fire as expectations for aggressive Federal Reserve rate hikes continue to weigh on investor sentiment. Yeah, it was a little weird. The NASDAQ was in the green most of the morning, and while the Dow and the Standard & Poor's were in the red pretty much all day. So that was a little odd. Apple led the decline in big tech, down more than 1%, even as some Wall Street reassessed their outlook on iPhone demand. Bank of America raised its estimates on iPhone sales to 237 million units from 231 million for Apple's 2023 fiscal year, after conceding that prior iPhone estimates may have been, quote, too conservative. Cisco was also a big drag on the market, plunging more than 14% after the network company reported quarterly results and guidance that fell short of Wall Street estimates, owing to the impact of China lockdowns. Quote, although the lockdown is expected to be lifted on June 1, it remains uncertain if improvements can be seen in the short term. Considering ports and airports are expected to be congested as nearly all manufacturers will compete for capacity to get their product shipped, in quote, Credit Suisse said in a note. Harley-Davidson reversed about 9% after suspending most vehicle assembly and shipment for 2 weeks after a supplier was caught in a regulatory compliance matter. Utilities and consumer staples, defensive corners of the market, also pushed the broader market lower, with the latter pressured by losses in Clorox, Philip Morris, and Molson Coors. Consumer discretionary stocks, however, shrugged off the broader market malaise as travel-related stocks, including Expedia, Caesars, and Booking Holdings, rallied as investors looking ahead to rebound in travel demand, particularly in China, where lockdown measures were eased. Tesla also underpinned gains for consumer discretionary stocks, despite Wedbush cutting its price on the stock, forecasting a China-led dip in deliveries for the second quarter. Wedbush cut its price target on Tesla to $1,000 from $1,400, pointing to the Shanghai lockdowns, which have been an epic disaster and are expected to modestly impact delivery in the second quarter, the research firm said. The economy front did little to soften fears of slowing economic growth ahead of jobless claims increased by more than expected, while the Philly Fed index showed a sharp downturn in manufacturing activity. In other news, Under Armour fell about 11% after the apparel retailer unexpectedly announced that Chief Executive Officer Patrick Frisk would be stepping down June 1. So again, none of this is stuff that I didn't expect. The crap we're headed towards was, with what happened 2 years ago and all the spending and the ignoring of the warnings of inflation, that was on the horizon, a year ago, when everyone else was saying, it's transitory, it's no big deal. It was a big deal. And the fact that these people just poo-poo it, no one was fired. Quite honestly, I think Jerome Powell should have been terminated from his position as Fed chair. And pretty much all the board of governors should have been terminated, because they put us in this position. So when you're pissed off in a year because you're having to pay $10 for a jar of peanut butter and $20 for a gallon of gas, I'm being a little hyperbolic, but it's these people in academia and in government who put us in these horrible positions. Nothing ever happens to them. They just move along to the next campaign or the next government project. And while the rest of us have to pick up the pieces and pay their salaries. All right. Oil rebounds from 2 days of losses in volatile trade. Oil prices rebounded from in volatile trade session on Thursday, bolstered by weakness in the dollar and expectations that China could ease some lockdown restrictions that could boost demand. Crude benchmarks continued their spate of wild swings, with both Brent and U.S. crude rising nearly $5 a barrel in a span of a few hours, recovering from losses earlier in the week. Quote, the market has been extremely volatile, said Andrew Lippo, president of Lippo Oil Associates in Houston. Quote, the market is reacting to all sorts of different headlines hour to hour, and the movement in oil markets on a day-by-day basis is getting even more exaggerated, end quote. Brent crude futures for July settled at 112.04, a gain of 293 a barrel or 2.7%. WTI crude futures for June settled up 262 or 2.4% to 112.21 a barrel. In China, investors are closely watching plans to ease coronavirus curbs from June 1 in the most populous city of Shanghai, which could lead to a rebound in oil demand from the world's top crude importer. Excuse me. Oil markets also rebounded as the dollar weakened. The broader dollar index was down 1% on the day after recent gains. Oil benchmarks often move inversely to the dollar as most global crude transactions are handled in dollars, so a rising greenback makes crude more expensive for big importers. Crude gains have been limited, however, with Brent and U.S. benchmarks trading in a range due to uncertain path of demand. Investors, all worried about rising inflation and more aggressive action from central banks, have been reducing exposure to riskier assets. Quote, Brent seems pinned above $100, but I think the recession risk and all the concerns about Chinese demand are limiting the upside and will continue to do that, said Bill Farron-Price, head of oil and gas macro research at Inverness in London. The looming possibility of a European Union ban on Russian oil imports has been supporting prices. This month, the EU proposed a new package of sanctions against Russia over its invasion of Ukraine, which Moscow calls, quote, a special military operation. I believe that's what we called it when we were murdering all those people in Iraq and Afghanistan. I don't remember the rest of the world boycotting U.S. oil. Strange. That would include a total ban on oil imports in 6 months' time, but the measures have not yet been adopted, with Hungary among the most vocal critics of the plan. Yeah, nothing's gonna happen. It's all just a big reason to send billions and billions of dollars over to Ukraine to fund the war effort to help out the defense contractors and to line the politicians' pockets. I have no illusions that these people are any good. All right, and more on the oil front. U.S. House passes bill to fight oil and gas price gouging. These are what we would call price controls. They worked very well during the Depression. The U.S. House passed a bill on Thursday that allows the U.S. president to issue an energy emergency declaration, making it unlawful for companies to excessively increase gasoline and home fuel prices. Again, this leads to shortages. Not a good idea. The bill must pass the Senate, which is unlikely, and be signed by President Joe Biden to become president or to become law. The legislation, sponsored by Democratic Representatives Katie Porter and Kim Schreier, passed the House 217 to 207, with no Republicans supporting it. Shocking. In the Senate, evenly divided at 50 members each, 10 Republicans would be needed to support the bill to pass. Never going to happen. Never going to happen. So, all right. So we see our government trying to go back to the old bag of tricks to try and hold everything together. But in the end, they'll just make it worse. The best thing that they could do was do nothing, leave it alone. It's what they could have done 2 years ago with this whole COVID nonsense. They could just done nothing, let people live their lives, make decisions for themselves. You know, if you're that worried about it, go out and buy a gas mask, put it on your head. But anyways, all right. Some economic indicator news. U.S. labor market in spotlight as weekly jobless claims hit a 4-month high. The number of Americans filing new claims for unemployment benefits unexpectedly rose last week, reaching a 4-month high and potentially hinting at some cooling in demand for workers amid tightening financial conditions. Still, the labor market remains tight, as the report from the Labor Department on Thursday also showed the ranks of unemployed were the smallest in almost 52 and a half years in early May. Signs of ebbing demand for labor were also evident in a survey from the Philadelphia Federal Reserve, showing a considerable decline in employment levels and the average work week at factories in the Mid-Atlantic region this month. The Federal Reserve's aggressive monetary policy stance, and as it fights inflation, has sparked a stock market sell-off and boosted U.S. Treasury yields and the dollar. Several retailers, including Walmart Inc., this week cut their full-year earnings forecast, warning that inflation was squeezing profits. Quote, this week, this will lead to slower job growth in the retail and e-commerce industries, end quote, said Bill Adams, chief economist at Comerica Bank in Dallas. Quote, the stock market sell-off could dampen business sentiment and make some businesses more cautious about hiring, especially those that are cash flow negative and rely on investors' money to fund operations like many startups, end quote. Initial claims for state unemployment benefits increased 21,000 to a seasonally adjusted 218,000 for the week ending May 14th, the highest level since January. Economists polled by Reuters had forecast 200,000 applications for the latest week. There was a jump of 6,728 claims in Kentucky, while California reported an increase of 3,315. There are also notable gains in filings in Pennsylvania, Ohio, and Illinois. Claims have been largely treading water since hitting more than a 53-year low of 166,000 in March. They have dropped from an all-time high of 6.137 million in early April 2020. Again, if we hadn't freaked out, this would be a big issue. All right. Last week's data covered the period during which the government surveyed employers about from the non-farm payroll portion of the May's employment report. Claims rose between the April and May survey period. While that would imply moderation in the pace of job growth this month, data next week on the ranks of the unemployed in mid-May will shed light on the state of job growth this month. Payrolls increased by 428,000 in April, the 12th straight month of employment gains in excess of 400,000. The number of people receiving benefits after an initial week of aid fell 25,000 to 1.317 million during the week that ended May 7th. That was the lowest level for so-called continuing claims since December of 1969. Continuing claims have been trending lower, even as initial applications for benefits have risen. Quote, one possible explanation for recent combination of initial claims trending higher and continuing claims trending lower is that layoffs have picked up, but people are still able to easily find other jobs, end quote, said Daniel Silver, an economist at JP Morgan. In a separate report on Thursday, the Philadelphia Fed said its business conditions index dropped to a two-year low reading of 2.6 in May from 17.6 in April. A reading above zero indicates growth in manufacturing in the region that covers eastern Pennsylvania, southern New Jersey, and Delaware. The survey's measure of factory employment dropped to 25.5% from 41.4 in April. Its gauge of the average work week fell to 16.1 from 20.8 in the prior month. Nearly 27% of firms surveyed reported increasing workers, the lowest in a year, down from 42% in April. Those reporting no change in the headcount reached 71%, the highest since December of 2020. So it's kind of mixed. There's plenty of jobs out there if you want them, and there's not a lot of unemployment. So if you're worried about getting a good job before things get really bad, you might look at a more of a recession-proof industry. Maybe grocery chains, things like that. Who knows? I mean, I can't speak for everybody in every area of the country. All right. Lastly, is the U.S. in a recession? Many analysts think so. This comes from the Center Square. The White House press secretary Jen Psaki said in October that inflation increases, quote, will be transitory, end quote. But today they have surpassed 40-year highs, and many believe the U.S. is already entering a recession or soon will be. Psaki said in a press briefing October 8th that, quote, experts, including the Federal Reserve, OECD, and others, end quote, expected, quote continues, inflation rises will be transitory and they will come back down next year. Well, it is next year, and they did. She said, quote, one of the best things we can do to bring down inflation is pass his agenda, referring to Build Back Better and infrastructure bills that cost trillions of dollars. Yeah, it's just, helicopter money out across the nation. That'll fix everything. More than 7 months later, several business leaders say the U.S. is already in a recession or is heading into one after the Federal Reserve increased interest rates twice already this year and is expected to do so again. Billionaire entrepreneur Elon Musk said the U.S. is probably already in recession in a discussion with the hosts of an All In podcast. Quote, we're probably already in recession and that recession will get worse, end quote, Musk said. Quote, there will probably be some tough going for a year, 12 to 18 months is the usual amount of time it takes for a correction to happen, end quote. One of the hosts, CEO of the Climate Corporation, David Freiberg said, quote, it feels like it started. Technically, we need 2 quarters of negative growth to be in a recession, but it feels like we're already in one. Feels like it's already started. The software business that we invested in are like the canaries in the coal mine, and there's a lot of dead canaries, end quote. Musk also said, quote, the obvious reason for inflation is the government printed a zillion amount of more money than it had. The government can't just issue checks for excessive revenue without there being inflation. Velocity of money held constant. Quote, it's hard to tell what Biden's doing, to be totally frank, Musk added. Last December, in response to being asked when the next recession would be, Musk said, quote, predicting macroeconomics is challenging, but around spring or summer 2022, but not later than 2023. Boy, that Musk guy's pretty damn smart. Deutsche Bank economist said last month that a recession is, quote, far from inevitable, end quote, because consumers and companies are flush with cash. Bloomberg News reported, quote, the U.S. economy is expected to take a major hit from the extra Fed tightening by late next year and early 2024, end quote. Averill financial analysts spoke this week about an impending recession. Former Goldman Sachs CEO Lloyd Blankfein told CBS News Face the Nation a recession is, quote, a very, very high risk factor, end quote. Morgan Stanley Wealth Management CIO on Monday projected a recession is 27% more likely in the next 12 months. On Tuesday, former Wells Fargo, we covered this in the article yesterday, Wells Fargo CEO Charles Scharf said at a Wall Street Journal event, quote, it's going to be hard to avoid some kind of recession, end quote. In April, inflation was reportedly 8.3%. However, many suggest it's much higher, pointing to grocery and other costs being 20% more than last year and gas costing 50% more than it did a year ago in many parts of the country. Yeah, well, see, they went and changed all the inflation data back in the early 80s and throughout the 80s. There's actually there was a website I went to and it listed all the different changes through the years. And I mean, if we calculated inflation the way we did in the 70s, it would probably be up in the teens from the smart guys I listen to, what they've been saying. All right. While Psaki pointed to 17 Nobel laureates having, quote, conveyed in order to reduce the risk of inflation over the long term, end quote, the spending bills needed to pass. It's the federal government spending that's creating inflation, critics argue. Well, yes. Quote, mountains of money cause inflation, Ron Serge, CEO of Target Date Solutions, argues in a report published by NASDAQ, quote, inflation causes increases in interest rates, lowering bond prices, and increasing interest rates, which causes reductions in stock values, end quote. Excuse me. The federal government's, quote, all-in spending was approaching $13 trillion as of mid-2021. That's more than U.S. spent in its 13 most expensive wars combined, end quote. This includes $5.2 trillion in COVID relief, $4.5 trillion for quantitative easing, and $3 trillion for infrastructure. COVID-19 related funding cost more than World War II did in today's dollars. $4.7 trillion, Serge added. The Federal Reserve is, quote, accountable to get inflation down to 2%, and that we have tools and we have the strong desire to get inflation under control, end quote. Fed Chairman Jerome Powell told Marketplace. Getting inflation down to 2%, quote, without having the economy go into recession or to keep the labor market remaining fairly strong, he said, will also include some pain. You're kidding, really? Shocking. But ultimately, the most painful thing would be if we were to fail to deal with it and inflation were to get entrenched in the economy at high levels, and we know what that's like. And that's just people losing the value of their paycheck to high inflation. And ultimately, we have to go through a much deeper downturn. And so we really need to avoid that. All right. So, even the smart people out there say, no, not just idiots like me who, have been saying this for quite a while, recession's on the horizon. That's really the only way to beat the inflation, unfortunately. So is what it is. All right. Well, I hope everyone got some value out of today's ramblings. I'll be back tomorrow with the weekly wrap up with, I have a really good article on, what is this? Where was it? Let's see here. It has to do with Federal Reserve policies aimed at creating price stability, bring about economic instability. So I'm going to cover that one tomorrow. I figure more people watch the Mondays and Fridays. So I'll cover that then. That comes from the Mises Institute, where there's a ton of smart people. So, all right. Well, I hope everyone has a fantastic evening. I'll be back tomorrow with, like I said, the weekly wrap up. If anybody needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And I'll see you guys tomorrow. Have a great evening. Bye-bye.